So good afternoon, everyone. Welcome to our second keynote speech of the 2021 Finance Forum. I hope you've been enjoying the sessions, despite the fact that we're holding the meeting in a virtual format. So today we have the pleasure of having Jang as our keynote speaker. She's going to give a talk about a very timely and interesting and exciting topic. So is, as you probably know, she doesn't need much of an introduction, but she's one of the most productive scholars in finance, not only in research, but also in terms of impact, teaching, and service to the profession as an editor of several journals. So she's currently the Arthur Burns Professor of Free and Competitive Enterprise in the Finance and Economics Division of Columbia Business School. She's also a research associate of the NBR and a senior fellow at the Harvard Law School Corporate Governance Program. She also served at Columbia as the Vice Dean for Curriculum and Instruction. So our research agenda is very broad, and you've probably read many of her papers in corporate governance, institutional investors, technology, financial markets, and let me emphasize her pioneering research in hedge fund activism, a topic that is very important, and shareholder activism is it's very important in research, but also in the industry. She has published many papers in top economics and finance journals, and an indication of the impact of her research is that it has been frequently featured in major media such as the Wall Street Journal, Economist, New York Times, or Financial Times. And another indicator of the quality and impact of her research is that she has received several awards from some of the top finance journals, the Smith-Meriden Paper Prize from the Journal of Finance, or the Michael Brennan Best Paper Award from the Review of Financial Studies, and the Jensen Prize from the Journal of Financial Economics. As I mentioned before, she served as an editor or associate editor in several top journals, Review of Financial Studies, Management Science, or Journal of Finance, and she was also a director of the American Finance Association. So we're very happy to have Wei today with us. So Wei, the screen is yours. So she's going to talk about an interesting topic, as I mentioned before. She's going to provide a new perspective on how we think about artificial intelligence, man versus machine, or man plus machine. And so we're looking forward to your talk. Let me just tell you that feel free to ask questions during the presentation. So we're going to do it seminar style. You can ask questions during presentation, also questions at the end. Wei, thank you, and the screen is yours.
Thank you. Many thanks to the organizer for this honor. As Megura have mentioned, we're going to do it a seminar style. So anytime, feel free to shout out if you have any questions. I think it's much more fun to make it interactive. So this is a paper that, instead of emphasizing a context between human beings and AI, we are going to find out what are the hinges that human beings and AI, or man and machine, can actually work together to do a better job. So it is a co-author paper with two scholars from Georgia State University, Shang Chao and Baozhong Yang, and also another faculty member from Louisiana State University, Junbo Wang. Now, I think it will be interesting to mention that among four of us, there are PhD degrees in economics, finance, mathematics, and accounting. So it's an indication that all different kind of interdisciplinary skills would be very, very helpful to pursue the new frontier research that connecting technology with finance. So let me start with the general motivation. Now, artificial intelligence, despite it being something that's artificial, after all, it was invented and developed by human beings. Of course, now machines can learn by themselves, but overall it's still under the supervision or guidance or planning of the human beings. So we human beings mostly come up with AI for the general purpose of making our world or making our own lives better. And this seems to be the general theme if you go to the technology or business sector. So they're interested in seeing what kind of new challenges AI can resolve and new products AI or services new AI can afford and can provide. But if you look at the literature of economics or finance, then most of the theme is a very, very concerning one. Say, gee, AI, just like the machines in the past or robots in the past, now it's AI, it's going to replace the human beings. Now, people think about robots as replacing or somehow displacing the people with arms and legs, but now AI is going to do the same thing toward our brain. And what is even more scary, that robots are probably replacing routine type of tasks that human beings would be very, very happy to receive and relegate. But if you think about AI, could be replaces the skills that we actually take pride in. Now, let me come back to the story that show this narrative probably don't need to be that pessimistic. Now, everybody knows the story of Garry Kasparov versus Deep Blue in 1997. So Kasparov was reigning chess champion at the time, and he was challenged by a machine called Deep Blue by the IBM. Now, there are multiple rounds. In the end, the conclusion was very clear that the machine won. Okay, so this is the story that everybody knew. Now, what is less known is that after the Kasparov versus Deep Blue, there were multiple rounds of similar matches between man and machine, including Kasparov himself, including some other few world top players against other versions of Deep Blue or machines from other firms. Now, very quickly, within 5 or 10 years, the suspense was all gone, meaning the machine rules in the chess playing. There's no more ambiguity that the top human beings that will even be able to get into the range of the capability of the machine. Now, even less known is that at the time, some people forecast to say, gee, if this is the case, human beings will completely lose the interest in chess playing, because who would like to spend so much time into something that your upper bound is sealed by even the machine, which was still getting better and better. Now, what counter that projection is that despite that all the sponsors and players have completely lost interest in man versus machine context, people have not lost interest either in the game or in the machine. So here, Garry Kasparov played an important role. So he was thinking about, gee, if I lose to the machine, it doesn't mean that if I team up with a machine, then we can still beat the machine. So he's focusing on his human incremental value to the machine that combined with the machine could actually beat the machine. So he and some technical people developed a new model that is called AI assistance to himself to play in the game. And this is what he called a centaur player. Now, centaur is a figure in the Greek mythology that has the upper body of human being and the lower body of a horse. You can imagine it's the human brain plus the power of animal that can beat older horses and beat older human beings. That's kind of the idea with it. Now, ever since the centaur player was in place, there have been contexts, although it's less covered by the media, that the centaur players can safely beat the top players because you still have the AI assistance. And more importantly, the centaur players can beat the current state-of-art machine. So this is kind of the direction that we are trying to go. Okay, so let me lay out the objective and outline of the study. Now, we hope that we provide enough constructive evidence that we can inform the following debate or the following inquiries. The first one is that probably we know that machines getting better and better. Okay, So we ask ourselves, can we actually amateurs, we're not, professional, this AI builders, but even for someone, a team like us, an amateur team, but knows the institution well, can we build a machine that beat most of human analysts? No, the moment we do, we can answer other questions. So we need to reach that credible step in order to be able to opine on the remaining other questions. Okay, so suppose we are able to build such a machine. Okay, so then we can ask ourselves, if we put the human beings and machine side on side, what are the human relative advantage over the machine? Okay, so this is the second stage. Now the third stage is that now we want to compare, not just compare, we want to combine the man versus machine. So the machine can help the man. Okay, so that's what we call AI-equipped analyst. Now, once we have the man plus machine, can such a combo actually beat the machine, and how much they can beat, and under what circumstances it can beat more? So that's kind of the last question. Now, it's always useful to put a new study in the perspective of the current literature, and we can imagine, it's not like exactly this similar paper we can pinpoint, but certainly we're intimately related to three strands of literature. Now, the first one is basically about a competition from and a threat to human workers posed by machines in the Industrial Revolution, now more recently the robots, and now the AI. So there's a long literature on that. It's an incomplete list. Now, the second one is actually a much newer literature, including some pursued by my colleagues at Columbia. Now, these authors are looking at the impact of big data and AI and how they have reshaped the financial industry that impact the mixture of product or services, as well impact the hiring strategy of the firms. So it's like we're coming to like the data assets is a new type of assets, and AI is new type of technology that could either augment labor or augment capital. Just change the typical production function that we're talking about. Now, the last one is basically we build on a lot of prior knowledge about how to develop machine learning tools and how to do the performance evaluation, how to process information, how to perform various tasks in finance. So this is a very, very technical literature. So like this technical literature is kind of 85% of the work in our paper, but that's not what we want to emphasize. So we want to take this as a premise, like we managed to do that, but focus on what we can learn from this process. Okay, so let me get down into the data quickly. So we are going to focus on the analyst forecast. Now, if you look at analyst forecast, most of the literature is about earnings forecast. But in our case, we are going to look at target price forecast. So I explain very shortly why we make that choice. So the sample ended currently, like these presentations, to 2016, because a couple of key variables from other authors, they were updated 2016, but no doubt we plan to extend in the time horizon. So the database is, nothing unusual. It's pretty standard database of IBES analysts and Chris Compute Stanford firm. But on top of that, we also incorporate all the SEC filings and macroeconomic information. So we have over about 6,000 firms, over 10,000 analysts from over 700 brokerage firms. And in terms of the number forecast, it's about 2/3 okay? Now here, let me delve into why we choose the price forecast instead of earnings forecast. Now on the affirmative side, although the literature mostly is about earnings forecast, but in fact, almost all the analysts actually issue price-based recommendations. And when they look at, when they project to the marketplace, when they want to make recommendations, in the end, they base on their price-based price-based projection. So whether you recommend a stock to be a buy or sell is about your projected price versus the actual price, while earnings is probably just input to this ultimate metric. Now, the real reason that while we look at the price forecast is that the price is formed by the market. It can be by the market perception of the fundamental value, or the market demand and the supply forces. So the firm has a very, very little power to shape the price. So if you look at the literature, firms can buy back stocks and do whatever, but you're affecting price by 2%. So the extent to which the firm can actually manipulation is a bad word, but the firms can shape the price. The power is very limited. But on the other hand, the earnings, it's not a very, very objective number, especially, it was well known when Jack Welch was the CEO of GE, for the over 90 quarters that he was the CEO, 3/4 of them, they always beat the analyst consensus by 1 penny. So that's it's like the firm decide to issue earnings depending on the analyst forecast. So you cannot really judge the analyst forecast precision on earnings that has a feedback effect. So this is we try to avoid, because if there's a feedback effect from earnings, then the human being accuracy is also affected by the firm's propensity to cater to or to beat the earnings forecast. Okay. Now we are also currently not looking at the buy-sell board recommendations, because it is a qualitative recommendation. It's very crude, who's right, who's not right. But if you look at the price, it's very clear comparing to the ex-post realization, say who get it closer. Okay, so the first step, as I
may I ask one question?
Yes, David. Yes,
yeah,
go
sorry.
ahead.
Yes. One question. In your analyst forecast, do you know what methods they are using to do the forecast? Because it looks like, I don't know what's going to come out, so I'm still waiting for the surprise. But if you can actually beat them, isn't it a bit worrisome that they are not using it? Above and beyond all of the other things that we are going to learn. But do you know how they are doing it? Are you anyway?
That's a very good question. The typical analysts, how would they come up with the forecast, right? So the top analysts, they all have a team for themselves, like the like O-star analyst. It's not like it's a person, it's actually a full team, and the full team is looking at very similar things as a machine will look at, because when we construct a machine, only have public information, and we're assuming the analysts are mostly, they are the aggregator and processor of public information. So every once in a while, they might have privileged information, but that's not the norm under regulation, fair disclosure. So we just assume the analysts are try very, very hard to process the public information. They're running predictive models, including regression models, and come up in the end with a summary. So they do very convoluted things. But when they issue report, they issue very, very simple metrics, like the year-end price will be $120. It's a buy, right? But below that level, there used to be 100-page reports. But at the top of the report, they want to print out their very, very simple summary metrics. Now, David, I think one thing, I don't know whether that's what you alluded to, is that what if the analyst also already is helped by machine behind it? I think that's what you're getting at, right? So
exactly, that was the point.
Exactly. So this is why we actually would observe the analysts are getting better and better over the machine, because we are constructing a machine in 2021, right? And we are using the current model, current technology to predict earnings in 99.6. Although we only use information up to 99.6, but the technology is today. So we safely beat the most of the analysts, because at that time the analysts didn't have AI at all. But more recently, they do. So toward the end of this study, we actually want to carve out a subsample that we know the analysts use AI and see how they perform. But that's a super, super important question. That's precisely where we want to go. Thank you, David. Yeah. Okay, so as I said, the first step is building our own AI. So, if we look at, there are a couple papers that look at the impact of AI on skilled jobs. So they're looking at external shocks to AI, like suddenly a new data set is available, suddenly Google developed a new model. So they're relying on external shock to see whether there's qualitative change of machine versus human being. Now, we want to build our own AI so that we can actually look at the cross-sectional variations, see what are the attributes would contribute to more machine advantage versus human advantage. So you cannot conclude that unless you actually have an AI analyst to work with. So basically every human forecast will have an AI corresponding AI forecast using the information, same information set adapted to the time of the forecast. So that's what we're doing. Okay, so I quoted this is Grana McKelly has a very interesting new paper that they precisely showed when there's a shock in AI technology and see how the profession of the analysts reallocate their time and job positions. Okay, so this is more like the job level analysis while we're looking at forecast by forecast, how does it go? Okay. So first one, we'll set up the information set for our AI. So we call it IT. Okay, so basically we make assumption, analysts are not expected to have access to private information because of Reg FD. They occasionally do, but we don't expect to be the norm. And even if we do, they work against us. Okay, so ideally, this IT should include all publicly available data and information up to T-1. So meaning it includes all the CompuStat and Crispin CompuStat data, all the SEC filing, and basically, if you want to include the Yahoo chat room, you could, but we didn't go that far. It's basically, and also all the news like Dow Jones type of news release up to T-1. So we construct a relatively comprehensive information. Is very important is to the second before the human analyst make a forecast. Okay. That's what we do. Now, how do we train the model? So currently we are using a 5-year training. So suppose, a human analyst made a forecast of July 2nd today. Okay. So we are going to make the AI information setting is to basically 1 second before the human analyst made the forecast. And we're not going to use any information from the analysts. Okay, because our machine is not helped by the analyst. We're not even including the past analyst forecast into the forecast model. Okay, so we are doing, say, if human analysts did not exist, how well would our machine do? That's the purpose that we're looking at. Okay, so we were looking at the data in the last 5 years of our own forecast and train a machine for the past 5 years. Say, hey, if you use the data in the last 5 years and trade against the actual actual realized stock price, what kind of forecast model would you use? And then we feed into the information to the T- and giving a prediction that's lined up with the current human analyst prediction. Okay, so our sample starts in 1996 because of the training requirement. Our first prediction is feasible in 2001. Okay, so it's very important that we do not include analyst forecast. So the machine is standing alone. It can make the forecast even the analyst did not exist. But later we'll combine them. But now we want to be very conscientious and separate. Yes, questions, Maria.
Can I ask a question?
Yes, please.
I mean, is it true that really you are excluding the analyst? Because, I mean, the point is that if the analyst did not exist, the price will have followed a different path. So, so the machine can learn from the analyst because the analyst information is being included in the prices. So, I mean, we cannot really see what will be the situation without analysts.
Yeah, so this is a very, very, very good point because some of the literature identify that some high-powered analysts actually can move the price, right? So that is a problem. So one thing we are thinking about doing is like excluding those like all-star analysts because most analysts don't have market moving power, but a few of them do, right? So we are also making some kind of assumption that the market price is the market market, it's not a beauty contest, right? It's not like the market set a price depending on what the next buyer is willing to pay, but the market set the price based on the fundamental value of the firm. So if you include the high iterative thinking in the market, Krebs and Harrison, those people develop those models, then it's not obvious what the machine should be forecasted. Should machine forecasting the fundamental value of the firm, or machine should be forecast what human beings are thinking? I think that's Maria. I think that's a very, very complicated question, and I must say, no, we don't have the answer. But currently, we just assume that's the reason why we don't look at earnings, because earnings, that impact will be huge. We look at like long horizon price forecast, but later when we see the long forecast versus short forecast, your impact, the effect that you mentioned will come back, because the short horizon, the human beings have advantage. Because in the short horizon, the analyst forecast is an input to the stock price. But the long horizon, the machine rules. I think partly it is due to this impact. Yeah.
I have a question, Wei, please.
Yes, please. Yes.
It's very interesting. Does your artificial analyst have a leaning towards technical analysis versus fundamental analysis? Are you giving the fictitious or the artificial analyst any inclination, any bias, or?
Yeah, very good, very good. Yeah. So unfortunately, our AI analysts cannot shake hands with the CEO. So they don't have that kind of intuition. Okay. So, and also I would say this is just purely quant. Of course, if you put in the fundamental regressors in a regression, is that quantitative or fundamental? That could be a mix. They're fundamental information. So when people see quant, they don't quite care for fundamental information. They just look at the diffusive jump versus the past movement. You form certain shape, volatility. That's pure quant. But But for us, it's a quantitative model that includes both technical indicators and fundamental indicators, if that's what you are saying. But the AI decidedly doesn't have the guts, doesn't have behavioral bias, and doesn't have intuition about which manager looks more confident. So for example, we can do that, but we didn't allow our AI to listen to the earnings, the press conference of CEO and assess, how confident the tone is. Like, we haven't done that yet. Okay, so basically this is a very, we kind of train our model until they beat more than half of the analysts, and we pretty much stop there, because we just want to receive that threshold, and then we can assess the relative performance. But you can go all the nuts about AI, because there's just so many more information you can add and increase the power of AI. So we're not at the peak yet. We're just kind of climbing up till we think, oh, we're at the reasonable height that we can say something about man versus machine and man plus machine.
Thank you.
Yeah. So okay. So now, so these are not like, as I said, the information is, when you do the machine learning, the information boundary is not very well defined. You basically tell the machine, hey, there's information, go count it. But let's just summarize the information with clear boundary. Just say these are the key information. And everything else is just kind of let the machine process the 8K and 10K. Okay, but we kind of still keep the past price characteristic, the whole profile, the diffusive movement, the returns, the earnings, characteristics, everything in the whole asset pricing and corporate finance literature. Now, here's a few interesting industry level variable that we're looking at. Especially, these days, if you look at the firm, what really affects their fundamental price movement, it's really about their competitive environment. So we're looking at the Li et al., the competition measure that's from the 10K. When I say counting the words, it's a little bit trivialize their work. But if you want to summarize what exactly this method is doing, is basically pick out the competition-related words. Okay. Now, Holberg et al. Had a very interesting paper they called market fluidity. So in general, when we think about product market competition, we're thinking about, how many players are in the same product space. But they say, wait a minute, the real competition coming from a firm from another industry that moved closer to you. And this fluidity measure precisely show how the rivals firm product moving closer to that as the focal firm. Okay, so the other industry affiliation, industry size, etc. But I think this competition-based measure actually turned out to play quite a key role in the AI learning. Okay. So these are the macro variables from the industrial, product production index to consumer price index to the crude oil to the default premium, treasury bill, etc. And then finally, so this is like incomplete. Let's just say what kind of information AI is processing. And finally, we also let the AI know, hey, text to sentiment in the various SEC filings are shown by the literature to have predictive power. So we're looking at the positive and negative sentiment by Loughran McDonald, as well as by the new paper by Chow et al., that using the managerial sentiment related to future performance, but isolated from topics not related to performance. So it's more like a refined version of Loughran McDonald, the sentiment words.
One question,
yes.
wait, please.
Yes.
So besides all this huge pool of data that you are giving to your artificial manager, does the manager know theory? Does the manager know models, KPM, time value of money, NPV, or I guess that is closer to the, what they really want to ask. I mean, is this guy just taking all these questions and predicting patterns, or it is also, trying to improve upon models? Does he have any idea about models?
Yeah. So the AI actually didn't know DCF. The AI doesn't know DCF. The AI doesn't know campaign. The AI is picking up a predictive model that show to have maximized the tension between in-sample fitting and the out-of-sample predictive power. That's what the AI
in that sense
does.
is closer to technical analysis, right? So it is not doing any fundamental analysis.
It's not doing any fun. It's not doing the discounted cash flow, no.
So to what extent your conclusions, whatever they are, I mean, I'm also waiting to see, is like, it's a horse race between fundamental versus technical analysis? It's not just human versus AI?
That's a very, very good question. Now, despite there no like DCF and no like the corporate finance, the AI doesn't know corporate finance theory, doesn't know Modigliani and Miller, okay? But AI is taking into fundamental metrics into the predictive model. So as if like you're doing DCF, but AI view DCF, doesn't know DCF, but is approximate DCF using a unstructured and nonlinear regression model, right? That's kind of what the AI does. So in the end, I think, Juan, I think you're right, but on the other hand, it is also precisely what it is. So in the end, the competition or the context between AI and human beings is a kind of context between technical capability and memory and processing capability versus human wisdom, intuition, and guts and those things. So in the end, it is about that. Yeah. Okay, so I will go very quickly about the machine learning model just to show what we have done, but I will not go into individual details now. These are in the second block. These are like these are the methodologies still used, considered to be very, very conventional. And these three models are considered to be, the current state of art. Of course, it's still progressing very, very fast. Now, random forest and gradient boosting are both like decision tree based models, and the long short-term memory neural network is the more like a newer generation, the neural network class of models. So what we do is that we tried everything, we trained everything, and in the end, we find those three models really, really beat the rest of the models. So we are building an ensemble model that make a composition of these three models that seem to be the most effective. Okay, and then we are going to see, whether they can how they would perform against the human analyst. Okay. So let's, I think, Juan already touched on this. Before we go into the regressions, we like to think about, say, what are the potential factors that man could perform well or poorly against the machine? So at least we can see what directions that we are going. So the one thing is that, we look at the public information transparency. So if we're in a very, very transparent informational environment, now we expect machines to just see it through, because machine has almost infinite capacity to process the information. Now we also anticipate the machine would be very, very potent if the information is voluminous, so captured by the number of 8K reports each year, or the pages of the 10K, they yield similar results. Now, one thing that a few questions already touch upon it is that we believe, currently it's very, very difficult for a machine to actually process intangible information, because the intangible information by definition is information that's very, very difficult to quantify. Okay, now that's the one thing we follow the current corporate finance literature to see what are the proxies for the extent of intangible information. So there's a recent paper by Evans et al. It's super interesting paper. So they define the tangible, intangible information as related to the organizational capital and the knowledge capital in the firm. Okay, so they have this investment and depreciation dynamic model, and organizational capital is associated with expenditures in GSA, the general sales and administration, while the knowledge capital is related to the expenditure in R&D. But they wrote up a dynamic model to see how you can count in the production, the depreciation and inputs. In the end, you construct or quantify both type of capital. So we follow that method to construct this the soft intangible capital as scaled by assets. Okay, and we do find that this is an indication that human beings could do well. Okay. Now, then the last element will be the analyst, information environment resources analyst phase per se. Now, I think Maria mentioned the issue that it's actually would be reflecting the remaining days to target date, because the analysts are more likely to have the market power in the short term, but it's very difficult even for the star analysts to have the long-term market power of the market price. The resources of the brokerage firm would also matter. It's proxied by the size of the brokerage firms, and also, just the how much information analysts already have conveyed as the number of predictions by the coverage by the analyst. Okay. Some additional factors that we consider, especially when we look at man plus machine. Okay. So the shareholder base would matter, because some of the literature talking about as a human analyst, you can talk to the institutional investors. They could give you more information. There's a micro, macro, and industry environment. And what we particularly find out is that when we talk to the people in the industry, they give us exactly the same feedback, is that currently all the machines are not very good at forecasting during industry distress. So distress by definition is a relatively rare event, because if you're in distress every day, it's no longer distress. So distress is a relatively uncommon event on the downside. Okay, and machines are just not very well to forecast that, or getting out of it to update its forecast. So the reason is that the power of machine really, really rely on the density of the training data. And the extraordinary bad time just don't have enough of timely dense data to train the machine. And they tend to be quite off. Later, I will show you the chart. During the financial crisis was the golden day for the human analyst. The machine just couldn't catch up. But once the economy, the best time that the AI can do is when the economy is a steady long rise, and then the human beings cannot catch up with the machines. Okay. Now, the last chapter of the study will also look at quantify the AI support within the brokerage, like JP Morgan, Morgan Stanley, they all invest tons in AI supports to boost up the competency of their human analysts, and they will also look at that to see how their analysts improve against the machine. Okay, sorry. Okay. Okay, so now let me clarify the exact layout of a model. So we were using man as a superscript for human and AI is a superscript for machine. And we'll feed on this unspecified set of information to the machine, and information is adapted to T minus. So what is T? T is the time when a human analyst make a forecast on firm I. Okay, so this is basically using information 1 second before the human analyst make the forecast. Okay, so we're using at the log price forecast because the price, as we all know, is a very, very right-skewed variable. So once you log the price, it becomes pretty much well-behaved, look like a normal variable. And it's also well known in the computer science literature that the forecast is the best if you can transform your variable into something that look like semi-normal or normal. Okay, so the AI, we would consider AI would beat the human being if the absolute forecast error for AI is lower than that of human being, and vice versa. Okay, so the big T is the target date. So we are just making it's not necessary that the last trading day of the calendar year. A lot of time, the analysts forecast last trading day, but T is really the target date. Big T is the target date, and the small t is the data forecast. So basically, on date small t, you're making a forecast of the price on date big T. Okay, so that's the model. Now, we want to admit that our AI forecast is really a lower bound because the four of us are really amateurs in this world. I'm sure the professionals can do a much better job, but we just hope given that our AI can beat half the analysts, at least we have something to say about the relative power between human and machine. Okay, so this is the time series, and we think it's quite informative in two ways. So this is the performance is the beat ratio. So basically, the percentage of human forecasts that beat the corresponding machine forecast based on the same information set. Okay. So there are two information. So one is that in the bad time, so this is basically this chunk is the crisis. Okay, so in the crisis, human beings did extraordinarily well. So if you eliminate this crisis, and human beings are very subpar. But this also show currently we cannot delegate everything our financial management to the machines yet. Because in the bad time, precisely when we need better information, the machine actually perform pretty poorly. Okay, and this is not just our weakness. We actually, present a paper at a couple of research-intensive asset management firms, and they communicate with us that their internal model had the same problem, and this is why they cannot completely go completely AI, because every once in a while something like this happened and your machine just so off. Okay, so this is the first, we admit it. We think, this is part of the discovery of this study, that what is the front the machine needs to improve upon. Now, the second thing is this red trend line, okay? So this is human beings are performing better and better against the machine. So part of the reason is that over time, our machine still machine. The machine doesn't have human being help. But over time, the analysts in our sample are getting more and more AI help. Okay, so toward the end, we actually going against man plus machine already. Okay, so this is why toward the end, we are pretty much at even. Okay, so it is also a race for ourselves. We also want to improve our model so that we can continue to at least beat half of the analyst. Okay, now this is a like progressive predictive power to see why the deep learning model is required. So if we just do a OLS regression, it still has machine learning on OLS. So basically, the OLS with a floating set of regressors, the machine tells us which control variable to include and which not to include based on the past training model. So it's not like all the variables in one regression. So basically, it's a machine-assisted selective OLS regression. Perform very badly. So if you're analyst, you don't need to be afraid of OLS. So OLS is a far away from displacing your job. Okay. So as we go through higher and higher, the machine learning model gets much better. And you can see there's a huge jump between this one and this one. So we are using the ensemble model of the past 3 and can beat the analysts at safely above 50%. That's where we stopped. Okay. So and also have a brief description about what each model is doing, but that's not the emphasis of a paper. Okay. Now, first we show that, okay, great, our machine can beat more than half of the analysts, but people will say, it's not difficult to beat the median analyst, because the analyst is a huge heterogeneous group, and in the end, only a few of them are good. Okay, so can your machine to beat the analysts who are a priori good? Now you cannot pick analyst skill by ex post realization, because that's just impossible, right? So basically say, hey, if you compare your AI with analysts that have good past track record, are you able to beat them? That's what we're doing. Okay, so we will sort all the analysts at median into 2 groups. Okay, based on their past track record. Okay, the average prediction error based on the past 1, 2, 3, 4, 5 years. Okay, and then we track the percentage of their future forecast that could be or could not be beaten by our AI. That's kind of the model. Basically say, if I am an investor, I'm choosing between analysts who are above average based on their past performance, or I choose AI. Whom should I choose? That's kind of equivalent question that we are going to look at. Okay, so there are 2 types. So one is just to say, hey, are you going to beat a analyst that's performed above average in the past 1 year, 2 years, 3 years, or above average during the 5 years as a one period? Or are you going to beat the analyst that's above average each year in the past 1 year, 2 years, 3 years, 5 years? So this one is a much higher hurdle. So this cells, meaning you're beating an analyst who's above average in every year during the past 5 years. This is like the top 10%. Okay, so this is always top 5%. And this is really the top 10% because each year in the 5 years. Okay, so you will see that analysts in the bottom half are safely dominated by the machine, but analysts at top half, they're still pretty good. Okay, so this is I think it's kind of very similar to other skilled labor, right? So if you think about a tax accountant in the past, when you prepare tax, you go to a tax accountant, right? Now you have TurboTax, right? So if you compare the tax accountant to the TurboTax, who can best prepare your tax report to save you the maximum amount of tax payment in a legal way, I would say half of the tax accountants are safely dominated by TurboTax. But the top half, they probably still have some unique skill that the TurboTax cannot do. I think if you look at the skilled labor versus machine, that's kind of the consensus people are reaching. So if you're the bottom half, you're very vulnerable. And if you're top 10%, you're still good. If you're top 0.5%, you stand a chance. I think that's kind of the general patterns we're observing. Okay, so the next we are doing an interesting exercise is basically in the sorting portfolio. That's if every time you write an asset pricing paper, you have to sort portfolio in some sections of your paper. So this is what we do. Okay, now in each month, so this is a monthly rebalancing. The turnover is huge, not very tradable, but we also do a 6-month rebalancing portfolio. The turnover is very manageable and seem to be more realistic. Okay, but let's start with this. So each month you get all the predictions based on all human analysts and their corresponding AI forecasts for these different horizons. So these are different portfolios depending on you have 30-day look back period or 1 year look back period. Okay. Now for each prediction, if AI predicts a higher price, it is a buy signal. If AI predicts a lower price, it is a sell signal. Okay. And if you have more buy signal than sell signal, it is a long position. And if you have more sell signal than buy signal, it's a sell position, it's a short position. So we are forming a long short equal weight portfolio accordingly. Now, what is interesting about this is that the typical long short position, you will always tilt it toward the small stocks. Okay, because the unique information coming from small stocks, signal coming from small stocks. This portfolio, there's no overweighting of small stocks because the AI and the human being, they could go on top of, they could go down with equal opportunity on big stocks and small stocks. Okay, so basically in market cap, there's no selection. Okay, so the stocks are held by 1 month or 6 months, and you reevaluate the signals and adjust the portfolio if the signals reverse. Okay, so that's the portfolio that we're doing. Okay, so this is the information horizon, and this is a monthly rebalancing. As I mentioned, if we do the 6 months rebalancing, results are pretty much similar. So these are the monthly excess returns, monthly alpha from the Farmer French 3-factor with the momentum 4-factor, Farmer French 5-factor, and Farmer French 6 factors. Okay, now the results are very similar with factor control because, as I mentioned, these signals are orthogonal to size and value and profitability, all those things. So they're pretty much factor neutral. Okay, so we are looking at about 65 to 90 basis points a year before transaction cost. Okay, and one thing that we immediately got asked is, say, gee, are the profits coming from the long side or short side? Because if you short the stocks, if the older profits coming from the short side, then it's not a very valuable or tradable trading strategy. It turned out the long leg is very, very profitable and the short leg is insignificant. Okay, so basically when the machine is recommending a lower price than the analyst, it's not very informative. And why? The reason is that analysts overall have a positive bias. Analysts overall have on average is a positive bias, and the market knows that. So if you're just working on just pointing out the analyst positive bias and you have a lower, like more pessimistic forecast, that signal per se is not very informative. It's not going to get you excess return. So I think that is kind of the economic intuition behind the total lackluster of the short side of return. Okay, so the next one we're going to look at is the determinants of the relative advantage. So when does man beat machine? Okay, so the dependent variable could be when the indicator variable man beats machine on a particular forecast, or the absolute forecast error spread in favor of the machine. Okay, and we have firm and year fixed effect. So it's really, really a pure within cohort analysis. Okay, so our hypothesis should be, the humans are probably better at just interpreting soft and discretionary information. Machines are more powerful in processing voluminous information. The brokerage resources matter, and machines tend to be less effective during the downtime. Okay, so that's kind of, yes, Juan.
One question. Analysts often publish these equity reports where they have this forecast due to an event. So they are event driven.
Yes.
Like a merge or a spin-off or any other. Yeah. So is there a way you can distinguish that, whether it is, just a regular kind of forecast or it is event driven? I guess the implications might be different because the machine doesn't know anything, or maybe it does. I think probably the machine doesn't know anything about the event, whereas the manager does, or the analyst does. So
that's a superb suggestion. So we haven't done that. This is a superb suggestion. So your point is that machine knows information set in the human beings, but machine is not taking into account what information triggered that human analyst to. That's a very good thing. Yeah. So we can look into, obviously, event-driven like CEO turnover or M&A versus routine forecast. That's a very good point. That's a very good point. Yeah. Okay. So the first one is amihud in liquidity. So when the stock is illiquid, meaning there's less information floating in the stock market, and human beings would be good. Okay. Now the size effect, there's not much in the cross section. There's not much, but within firm fixed effect, when the firm gets larger, the analyst gets less advantage. But we don't think this is very clear result, because for the market cap, we're most interested in the cross section, but in the cross section, there's just no result. So human beings and machines seems to be an equal force in the large and small stocks. Now, the AK reports volume clearly will work in favor of the machine, and intangible assets works in favor of human beings. And analyst forecast horizon work in favor of the machine. So basically, in the short horizon, human analysts win, and the long horizon, the machine wins. Because a lot of like intangible clues and cues, I think the human beings can pick up for the near term. But in the longer term, it's a more objective-based forecast, and machines start to take over. Okay. Now, this is important. So analysts in the large brokerage firms tend to perform better. It could be analysts, just better analysts. They work for better brokerage firms. And also could be just the resources are better. Okay, so these are and finally, during the industry distress. So industry distress is meaning we have two indicators. One is that the absolute return has to be negative during the past year. And the second, that has to be the bottom decile of all industries. Okay, so if the booming year, you're just relatively good, relatively not good, it's not a distress. It has to be both negative return and bottom decile. So show that in the distress years, the human analysts do significantly better. Okay, so if we look at the forecast error spread, it's basically it is the unit is the percentage point in terms of the price, the forecast error as a percentage point of price, and these are basically 30 basis point and 20 basis point. They're more or less in line with the qualitative predictions.
Sorry, wait,
yes.
one question. So I was wondering to what extent there's sort of an asymmetry or not, because you have industry distress, looks to be bad moments, bad aggregate moments. Yeah. And is there something also similar for industry booms that go in the opposite side or not? So what I'm trying to figure out is there something here? I guess that some measures point to that. When it's more difficult to value something, whatever that means. I'm not very clear in that, but I have my concept. I don't know how to split it up in a measure. Then as we know, the man has an advantage because this is not from history. The last financial crisis was not in the data, basically. So then you need someone that is thinking outside of the box or without the data. I was thinking if this, sorry, and just to finish, and I was thinking if the same happens in unexpected booms, maybe the tech industry bubble, but I think that's not in your data sample. So, something that is not only a bad boom, but also a good boom. Suddenly, out of the blue, all of this set of stocks just go crazy up. Anyway.
Very good, David. So I think you're giving us a very, very good suggestion that we haven't done yet. So indeed, now I realize this industry distress is not clear whether it's distress or just extreme. Right? Extreme could be two-sided.
Exactly.
So, so in the macro event, right? In the macro event, so if you look at the market wide, there are 4 standard deviation downward movement, but there's no 4 standard deviation upward movement, right? So in the macro levels, it's only distress. The boom is a diffusive movement, while the bust is a jump, right, in the aggregate level. However, individual firms could have positive, negative jumps. So what we should look at is individual positive jumps. See what after Apple, I'm thinking about after Apple announces the first iPhone, who is the best? That's very good. We should look into that. That's very, very good. Yeah. Let me write it down. Very good. Yeah. Okay, so let's go into the last chapter, which I also think it's the most important chapter, is basically how do we combine wisdom of man and machine. Okay, so we are going to follow Gary Kasparov's route. So he constructed a Centaur chess player, and we're going to construct a Centaur AI analyst. Okay, so here is that before, remember, in our AI model, we deliberately exclude any information provided by the analyst. Okay, so now we will put in all the information provided by the analyst, including analyst's current forecast. Okay, so basically we're using all the information analysts have on top of that, the other information processed by AI. So it's a net addition. It's a net addition. Okay, so basically now the Centaur analyst has information from everything that the the analyst has. The summary statistic of that information is actually their forecast. But we also include anyone's past forecast plus the information that our AI already has. Okay, so now we are going to compare the forecast errors by this Centaur analyst separated with a plain machine or lone man. Okay, now when we ask ourselves, why can machine help human beings? Machine can help human beings for two main reasons. One is that human beings are mortal, right? And we are just subject to our biases. The biases could be our cognizant limitations, like recency bias, whatever bias. It could also be our conflict of interest. I want to cater to the management, right? The machine doesn't know these biases and could not possibly have the biases, right? So the first thing is that let's construct a man improved the machine. Okay, so basically, if the man can correct, the man will try to forecast the bias of the analyst and debias. Then the machine improved man can beat the analyst about 56.9% of the time. Okay, so remember, this is not about if the analysts have an average bias of 2%, I shave off 2%. No, that will get the quality to be much worse. Has to be individually forecasted bias and individually debias. And it will dramatically increase the performance of the Centaur. Now, the second one is that I also feed in the machine process information, okay? But do not try to debias, okay? And this one has, these two are not the identical number, just they happen to be identical to the first digit after the decimal. It's just a coincidence, okay? Now this one that I don't debias the analyst, I just process my own information, combine it with the analyst information. It can also beat 57% of the time. Okay, so basically say, if you use human beings' inputs, but either correct their bias or augment their information processing, you can beat them 57% time instead of 54. Okay, now the man plus machine can also beat the machine 54% of time. Okay, so this is basically a Centaur analyst is better than an analyst, and a Centaur analyst is better than the machine. That's the promising part. Okay, so let me show the charts. Okay, so the MIM is machine improve the human being. So machine is not processing the additional information, but just correct your human bias. So this is the raw man beat machine, and this once they correct their bias, this is the new man beat machine. Okay, and the advantage is increasing over time. Now this is even better. This is the full Centaur analyst. Basically, I have all the information from the man, all the information from the machine. How would it beat the machine? And this is just the pure analyst beat the machine, and this is a Centaur beat the machine. Okay, so the Centaur analyst almost always, be above the 50% neutral line, and also it's increasing over time. Okay, so we think this blue chart actually speaks to a bright future of man, not a bright future, not just a bright future of AI, but the bright future of man. Basically say, if a man is willing to be equipped or augmented by AI, then the future is pretty bright, and it's also increasing over time as well. Okay, so now we get down to a regression framework, and let's look at incremental value of man, incremental value of machine. Our focus is incremental value of man. Okay, now the incremental value of the man is not the same as a relative advantage of the man or the strength of the man. So for example, suppose that two analysts, they were equally good before the machine came along. One analyst was extremely good because they have incredible memory. The second human analyst is extraordinarily competent because they have extraordinary intuition. Now the machine comes, is going to displace the first analyst, but not the second, even though they were equally good before the machine came along. Okay, so this would differentiate an incremental value of the man versus the competence of the man on its own. Those are two different concepts. Okay, so we are going to have the dependent variable to be man plus machine beats the machine, or man plus machine beats the man. I think the first is more interesting. And then we look at incremental value of the machine versus that of the man. So basically, the man beats the machine. The forecast average spread of the centaur and the machine is the incremental value of human. And this is incremental value of machine. Okay, so we'll see which one would win out in the age of a centaur AI.
One
Okay.
question, please.
Yes, yes, Pedro.
Yeah, so
So Pedro, I think your sound is a little bit muffled.
okay.
Yeah.
Do you hear me better?
Yes,
now?
yes, yes.
Okay. Yeah, there is a way of naturally improving the demand forecast. That is the way of joining several months. I mean, the power of the group.
Yeah, yeah.
My question is if you test it in the as dependent variable. I mean, if the instead of man plus machine, men plus machine, or I mean the power of the group.
Yes.
Because you are using forecaster, and my point. I mean, the idea relies on two bases. The first one is that you are using forecasters of the same, or analysts from the same firm, and I don't know to which point those forecasters are colluded, or they are they providing the same forecast. And the second one, it reminds me this idea of the book of super forecasters, when they put all those super forecasters in the same room in order to get some predictions.
Yes, very, very interesting. So we haven't done that. So basically, instead of MAN versus machine, should be MEN versus machine, right? That's the idea. So we should do that. So basically, the idea is to construct a consensus, like analyst consensus in an optimal weighting way, right? And see to what extent the machine can beat that man, MEN, not MAN, and also see what would be the human beings can survive the new era by grouping or crowdsourcing their own common wisdom. That's a very, very interesting suggestion. Yeah. Okay, so here is like the incremental value of the man. So incremental value of man is basically the forecast error spread of the centaur analyst minus the machine. So the incremental contribution will be from people, from human beings, right? You know, the intangible assets remain the same. So a lot of intangible assets is where human beings have more incremental value. The longer horizon, the short horizon, human beings have more incremental value. Now, I highlight two non-results as interesting. Because remember, for individual analysts, when there's information is more voluminous, the human beings have a negative advantage. Now, the incremental value of the man doesn't decrease with the information volume. So when an analyst could be equipped by AI, then the volume of information no longer puts you at a disadvantage. Your incremental value is not the volume information is not detrimental to the incremental value of the man. Now, the second one is that this coefficient now close to 0, while it was highly significant in the man versus machine context. So what is this? This is the number of analysts in a brokerage firm, or how rich, how resourceful the brokerage firm is. So before, if you have a man versus machine context, right? Analysts in rich or more resourceful brokerage firms are more likely to be the machine. Now, if you give every analyst our AI help, then analysts in small brokerage firms no longer behave worse relative to analysts in the large firms, okay? And we find this result to be quite interesting because it shows a democratization of the AI, okay? So the similar thing that in the internet age, the research productivity of the leading schools versus next tier schools, they have become far more flat than compared in the past time, because you could be augmented by communication and technology tools that's available to everybody. So I think this is pointing to the same trend. Okay, so I think I have 15 minutes. I think it's a good timing. I want to share the final event study that really point to the future of man plus machine. Okay, so when human analysts receive AI inputs, can they outperform our AI analysts? That's the question. Okay, before this one is like the cross-sectional panel analysis. You know, we're not claiming any causal implication, just kind of the within cluster and cross-sectional correlations. But let's look at a more sharp event to see whether we can accomplish better identification for the same message. Okay. Now, between 2011 and 2016, there's a new type of data became available. That's basically satellite image. Okay, so the satellite image will go into, you know, mostly the parking lot, but also the shipment of goods, etc. So if you see Home Depot, the parking lot is full, you know, the Home Depot is going to get a good business. Same thing for McDonald's and Starbucks. So these data available was a very sharp event. It was not available at all, and it suddenly became available. It's a very sharp event. And the coverage is also staggered. So the Cortana et al., with this super cute paper, and they basically have a list of 44 firms whose satellite image became incrementally staggeringly available during those 5-year periods. So they actually know which date that image became available. So when the image data satellite data became available, that is the feasibility constraint, because the data is not there. It doesn't matter whether you have AI or not, you cannot analyze this data, right? When the data became available, at least we know some firms, brokerage firms or asset managers could buy the data and analyze the data, have a leg up. And these people do show when the satellite data become more available, then earnings surprise become less surprise, because people already know by processing the parking lot data, know the earnings, not know the earnings, but have better prediction of the earnings. Okay, so we are making an assumption. If a firm invest a lot in AI, it's like a firm like Morgan Stanley, they invest a lot in AI, and we think their analysts are more likely to benefit from the alternative data. Okay, so there's two differences. One is before and after the satellite data become available on a given firm. So if the firm suddenly gets covered by the satellite image data, that become a treated firm. That's the first difference. The second difference is AI equipped brokerage firm versus low AI investing brokerage firm. That's a second difference. And that is the paper by Babina et al. We follow their methodology to sorting out brokerage AI hiring versus non-AI hiring. Okay, so this is the double diff in diff. One is the post coverage. The second one is brokerage AI capacity following the Babina et al. Paper. Okay, so what we are finding is that the man beat the machine. Remember, for the man to be covering, for the analyst to be covering the treated firm with AI capacity brokerage firm, they're already AI plus man. That's kind of what we are testing. Okay, so what we show is that the triple term is the most important and most significant. After a firm is covered by the alternative data, post coverage, and in a brokerage firm that high AI talent, And those probability of man beat the machine is dramatically higher than the otherwise. Now, unconditionally, when a brokerage firm has AI hiring a proxy for AI investment, they always come ahead, but they come ahead dramatically more after the firm is covered by the alternative data. Okay, so this triple term is an indication that the centaur type of analyst is the one that convey or boast the biggest advantage over either machine or the human beings. Okay, so the other terms are just controlling. And what is important is that the data coverage per se is 0, meaning the data coverage firm and the uncovered treated and untreated firm are a priori very similar. So before the event, there's no difference. Okay, but when we interact with the triple difference, then they will come out. Okay, so I think I will end about 10 minutes early and can entertain and accept more questions as well, seek more feedback and suggestions. So let me conclude. So here we are building AI analysts to the extent of beating the majority of human analysts, so that we have a premise to assess the relative advantage between man and machine. Okay. So the AI, we find that AI commands advantage when the firm is very complex. This voluminous information, the information is high dimensional, the information relatively transparent, then the machine comes ahead. Human comes ahead when the critical information requires institutional knowledge or when the situation is unusual. Okay. We also show that we should not be so afraid of AI, because in fact, the edge of AI over human beings is declining over time, not increasing over time. The reason is that human beings increasingly gain support and access to alternative data and in-house AI resources. So we hope to have portray this bright future, not a gleam future, that combining AI and art of human being, that will give human beings the best opportunity to have a fulfilling life and fulfilling career. So I think I will end here and will welcome further questions and comments.
Great, thank you so much for this very interesting talk. I really appreciate it. Thanks for being here with us. It was very interesting, and it's a really timely topic. Thank you. Any questions from the audience?
Yeah, I have
time. Go ahead, Juan Pedro.
Another question.
Yes, please.
So if I understood right, maybe you mentioned this, but I didn't follow. So you're comparing a single artificial intelligence analyst with the average analyst, right? But then since you are considering a bunch of guys, human guys, human analysts, you have another dimension there, which is the dispersion. Right, there are going to be moments where there is a higher, they agree, whereas they are dispersed. I wonder whether you can use that.
Yes.
Whether, I would say that probably, I very much like the idea that machines can actually keep their head cold. Okay.
Yes.
So that can be one of the contributions. So whatever you can say or you can document through tests regarding how machines correct optimism, okay, or bias, optimism-induced biased, I think is going to be very valuable. And I don't know whether dispersion is going to give you some hint about that to identify situations, or you can identify a set of stocks which are more likely to be, subject to optimism by analysts, and see whether in that case the machine moderates the behavior. That would be super cool. I don't know honestly how to implement that, but anything in that direction I think would be very valuable. And thank you very much.
Super comments. Yes. So we do want to develop the model, basically say, get the best of the human crowd wisdom, right? And that the machine the machine doesn't need to do additional work, but the machine keep its head cool. And we can construct a proxy from the literature, then you expect the positive bias to be the greatest, and see whether machine can target those, right? That's what that's super useful comments. Yeah, super useful comments. Very good. Yeah, we'll do that. That's so useful. Yeah.
I had a thought about the same aspect in terms of crowdsourcing. So currently you're looking at a group of analysts who maybe belong to the same financial services firm or different firms and comparing it to the machine.
Yeah.
is there an element of competition inherent among these individuals versus if I look at a group who's, let's say, collaborating over Wall Street bets or Reddit, and they're trying to beat price estimates, there'll likely be collaboration there. So is there a way that there's competition on one group of men and there's probably collaboration in the other group, and maybe the relative advantage could be different when you replace the elements there? So yeah,
very good, super cool. Yeah, it's related to Huang's comment. Basically, you want to say when the human beings engage in an arms race versus human beings are combining their own common wisdom without the machine, or how can the machine? That's super cool, super cool. Yeah, yeah.
Hi, Wei. Your research is so interesting. Can you hear me?
Yes,
okay. This is Gracie from Fudan University. So you mentioned a lot about intuition and the gut. So I'm wondering whether you have considered to model it. The reason I am asking so is because there is psychology literature modeling people's capabilities into 4 elements: thinking, sensing, feeling, and intuition. So I'm wondering whether we could map those capabilities in psychology into the AI versus human beings forecasting ability here, to see whether the differences are coming from intuition or feelings.
Okay, that's very good, Gracie. Thank you so much. I wonder, after the talk, do you mind, sending me a representative, because I'm not a psychologist, I'm not familiar, but
sure.
Send me like a representative research work. I can start from there, because I think we can construct some proxy for when the intuition part is dominant, but currently I don't know, but it's a very interesting lead.
Okay, thank you.
Yeah, thank you so much. Yeah.
Any other questions?
Yes, please.
So one further question. So wait, is there any data of what happened during COVID? So I'm a bit obsessed with this thing of, what happens in, let's call them normal times versus non-normal times.
Yes.
Because what's the issue that I'm somehow worried about is, up till now, like from Pedro, I like very much this idea of, okay, the machine keeps his head, cold head, but maybe sometimes it keeps the cold head in a way that we shouldn't be keeping.
Exactly.
So
Yes. So we eventually want to expand the sample to 2,000, that we can look into this. So I think, David, you're pointing to a very, very interesting point, is that sometimes head too cold is not good. So the reason we find out is that, in 2010, machine did very poorly, because human beings, you see like people are flocking to the restaurants, people are flocking, but the machine doesn't know. Right, you are seeing like in New York, you see, oh, Times Square is picking up, right? So the streets become so bustling, the subway becomes so crowded, but the machine doesn't know yet. So actually, the human analysts pick up the recovery, like we're out of the recession faster than the machine. Yeah, that's a very interesting point. We'll think about, we as a researcher also have this intuition, but we don't know how to quantify it. So we also have to look into this, but this is a super cool idea. Yes.
I have one small comment question, if you wish. I was wondering if you did anything to differentiate between the underperformance of machine during the stress times, industrial stress, versus underperformance of machine for forecasting the stock price of distressed firms. So what I'm wondering is, because distressed times for firms are really difficult times to assess the value of the firm, because there's a lot of things going on. There's a lot of uncertainty. There are vulture investors. What are you going to be able to do private workouts, or are we going through Chapter 11? So how do you treat those firms? Because there will be less analyst coverage. Some firms will be delisted. Maybe we'll start trading at the OTC market. So how does that play out in your setting?
Yeah, so even though we term the distress, we're not actually like the legally distressed. So you're right, Irene. When the firm is truly distressed or move to the pink sheet or move something, analysts just drop those firms. They're actually censored from our samples, because we don't have analysts to compare. So I think in those firms, I would think machine has the has the absolute advantage because human beings not even covering it. So what we show is that in the relatively downtime of the industry, human beings still do better than the machine. And in fact, if you say, if you want us, our AI analysts, to cover a firm that's about to be bankrupt, already bankrupt, I would anticipate to be very, very poor. The performance be very poor.
Yeah. Any other questions?
Well, I must say, the comments, the quality of the comments and the creativity of the comments, it's just unprecedented. I just feel so honored and just so happy, to receive these comments. The comments are actually very different from what we received from previous seminars, but they're just so creative and just really, really kind of push us into a new direction around very new tests. And I couldn't wait to get the new results and share back with this audience. Thank you.